It's a question on everyone's mind. Will the Canada housing market crash in 2025? As of October 2025, the short answer is no. A full-scale, nationwide crash isn't the most likely scenario. However, the market is definitely in a correction phase, and there are still significant risks for steeper declines in certain areas. This isn't a simple yes or no situation. It's complex, with many moving parts influencing what happens next. I've been following this market closely, and I want to break down what I'm seeing, the good, the bad, and what you should be aware of. Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy McKay. Let's get right to it. Looking back for years, Canada's housing market was an unstoppable force. Low interest rates, growing populations, and a healthy dose of investor enthusiasm sent prices soaring. From the aftermath of 2008 right up to early 2022, it felt like home prices could only go in one direction, up. The Teranet National Bank House Price Index paints a clear picture. National prices more than doubled during that period, reaching peak levels in early 2022. Then, things shifted. Inflation kicked in, and the Bank of Canada started hiking interest rates. This was the crucial turning point. Suddenly, the cost of borrowing money became much higher, directly impacting what people could afford to pay for a home. Many analysts now see the period we're in as the pop of the bubble that was forming. BMO Economics even suggested that Canada's housing market was looking a lot like the US market before its 2008 crash, with households heavily in debt and speculation playing a big role. In fact, some discussions on platforms like X have pointed out that Canada has already seen a far larger evaporation of market value in 2025 compared to 2008 to 2009. It shows us that prolonged corrections can feel just as painful as a sudden crash for many. So, what does the market look like right now in the fall of 2025? It's definitely not the frenzy we saw a few years ago. It's more of a low-key environment, as one RBC report put it. Here's a look at the key numbers. The national benchmark home price sits around $701,900. That's down about 3.6% from this time last year. While that might sound concerning, it's actually the smallest year-over-year decline we've seen in a while, suggesting prices might be starting to stabilize. We've seen some improvement in sales activity. August 2025, for instance, was the best month in 4 years. However, overall transaction volumes are still not hitting the historical averages we've seen in busier times. Here's a big one reported by the Canadian Real Estate Association. There are 195,453 properties available across Canada, which is 8.8% higher than last year. With more homes for sale than in recent years, buyers generally have more choice and more negotiating power. This surplus is definitely playing a role in keeping prices from climbing higher. While new home construction has been steady, CMHC forecasts that overall housing starts will likely fall below 2024 levels. This could mean that long-term supply issues might still be a concern. Interestingly, the rental market is also showing signs of easing in some major cities. Reports have indicated double-digit year-over-year declines in rents in places like Surrey and Vancouver, which can be a breather for many. Several factors are creating this mixed picture. The Bank of Canada has been cutting rates, which normally spurs housing demand. While it has brought some buyers back into the market, the sheer amount of available housing inventory is currently a stronger force influencing prices. If rates continue to come down to a more normal level, say 3 to 4%, we could see more activity. But if inflation flares up again, the central bank might have to pause those cuts. Canada continues to welcome a lot of new residents. In 2025, nearly 1 million new people have come to Canada, which naturally increases demand for housing. This population growth is a significant factor that has helped prevent a full-blown crash. However, it also puts pressure on existing housing supply, leading to ongoing debates about affordability and infrastructure. This is a critical piece of the puzzle. If Canada were to slide into a significant recession and see unemployment rise, that would put a lot more pressure on the housing market. Many Canadians have high levels of household debt, And with many fixed-rate mortgages taken out in 2020 to 2021 coming up for renewal in 2025 to 2026, they will face higher payments. This mortgage renewal cliff is a real concern. Things like changes to mortgage rules, foreign buyer bans, and provincial programs all have an impact. The CMHC, for example, forecasts that housing prices will actually grow faster in 2025 before slowing down further down the line. But these forecasts can change quickly based on policy shifts. There's also talk about the boomer bottleneck. As people from the baby boomer generation age, some may choose to downsize or leave their homes, potentially freeing up more housing stock. This could ease price pressures over time, and some predict this will become more of a factor by 2025. We can't ignore what's happening outside of Canada. Trade disputes, global economic slowdowns, or any major international events could ripple through our economy and housing market. Some analysts have even suggested that if specific trade tariffs materialize, we could see significant price drops, especially for single-family homes in areas like Ontario. On the flip side, some experts believe elements like AI being used to make housing more efficient, and people's preferences for different living arrangements like suburban or rural living could help stabilize the market. One of the most important things to understand is that Canada's housing market is not one big uniform entity. What happens in Toronto is very different from what's happening in Montreal, and even different within provinces. Here's a quick look at how things are varying. In Toronto, prices have fallen by about 5.4% year over year. Sales have been really slow, and inventory is high. Condo prices are at multi-year lows. Vancouver has seen prices falling with rentals down by about 9.5%. It's a record high inventory, one of the slowest markets we've seen. Montreal, on the other hand, is seeing a strong market with prices up by about 8%. It's still setting new records, with lots of demand. In Calgary, prices are down year over year and month over month. The market has shifted to favor buyers after a period of gains. Edmonton's prices are flat, with growth stalling after a period of increases. Atlantic Canada, like Nova Scotia, is experiencing steady, moderate growth with price increases ranging from 3.1% to 8.1%. In the prairies, places like Saskatchewan are seeing some areas, like Regina, really heat up with a 6.5% increase. This shows why it's unlikely we'll see a single nationwide crash. Instead, we're likely to see deeper corrections in areas that experience the biggest price run-ups or have specific economic challenges, like some parts of the Greater Toronto Area. Nobody has a crystal ball for the housing market, but here's a summary of what various experts and organizations are forecasting. The CMHC forecasts stabilizing prices with faster growth, slowing by 2027. True North Mortgage predicts a 1.5% national decline with a prolonged recovery. Oxford Economics suggests a stable market with no boom or bust, while RBC sees a slight increase, highly dependent on rates. TD Economics forecasts a 7% year-to-date increase, suggesting a healthy near-term outlook. It's clear there's no single agreed-upon prediction of a dramatic crash. Most forecasts lean toward stabilization or modest price increases, especially if interest rates continue to fall. However, the pessimistic views mention that if a recession hits hard, we could see drops of 20 to 30% in some areas. Given this mixed outlook, what should you do if you're involved in the housing market as a buyer, seller, renter, or investor? If you're looking to buy, this correction means prices have come down, and you might find better affordability in some markets. But be careful. Don't stretch your budget too thin, especially with that mortgage renewal risk looming. With more inventory on the market, your home might take longer to sell than it did a couple of years ago. Pricing competitively and being realistic about your expectations are crucial. In some cities, rents have softened, which can be good news. However, rental prices are still tied to the broader housing market and economic conditions. For investors, this might be a time to be more cautious. Consider focusing on properties that generate steady income and avoid taking on too much debt. If you're looking for safe havens, some advisors are suggesting diversifying into other assets like gold or private equity. The most important thing is to stay informed. Keep an eye on the Bank of Canada's announcements about interest rates, watch the economic data closely, especially unemployment figures, and pay attention to what's happening in your specific regional market. To me, it feels like the Canadian housing market is navigating a very sensitive period. A full-blown crash is not what most reputable economists are forecasting as the base case. However, the massive run-up in prices, combined with high household debt and the potential for a softer economy, means that risks for localized price drops are absolutely real. We've seen a correction, and it's likely to continue in some segments and regions. The challenge is that the positive forces like immigration and potential rate cuts are battling against the headwinds of affordability and economic uncertainty. It's not the time for panic, but it is a time for pragmatism, due diligence, and careful planning. The St. George, an innovative multifamily development located at 321 St. George Street in Toronto's Annex neighborhood, has been making waves in the real estate community. This project, developed by Green Street Flats, is a shining example of how affordable housing can be successfully integrated into one of Canada's largest cities. The development, which was recently awarded the 2025 CoStar Impact Award for Multifamily Development of the Year in Toronto, stands as a testament to creative solutions in addressing the city's housing crisis. Originally a modest single-family home, the St. George has been transformed into a vibrant 22-bedroom, 9-unit multiplex, complete with a garden suite. The development significantly increases residential density in a walkable and lively part of Toronto. This project bridges the gap between single-family homes and towering condo buildings, effectively filling the so-called missing middle housing that is so crucial in today's market. Green Street Flats, led by President Leonid Kotov, faced a challenging zoning and approval process, requiring 7 variances, including extending the building depth beyond the permitted limit. Despite these hurdles, the team successfully navigated these complexities, demonstrating a commitment to creating affordable, family-friendly housing options in a city where such options are becoming increasingly rare. The St. George offers a variety of unit types, including 4-bedroom, 2-bedroom, and 1-bedroom units, catering to a diverse range of tenants from families to young professionals and students. Its prime location near a bike path and just a short walk from the DuPont subway station provides excellent access to Toronto's transit system, making it an ideal choice for those seeking sustainability and convenience. Industry professionals have recognized the impact of the St. George, noting its role in providing affordable units in a supply-constrained environment. Paul Macchione, Senior Vice President of Industrial at Cadillac Fairview Corp., highlighted the project's importance in utilizing existing transit infrastructure and preventing further urban sprawl. Alan Grinberg, a principal at Avison Young, praised the rejuvenation of the asset and called for more developments of this type. Alana Kantkier, National Vice President of Retail Leasing with JLL, commended the project for addressing the city's housing crisis and affordable rental needs, emphasizing the strong community impact and thoughtful design that includes outdoor space for residents. Craig Wagner, Vice President and partner at Berkshire Axis, acknowledged the challenges faced in dealing with city regulations and applauded the team for their perseverance in bringing the project to fruition. The St. George exemplifies the future of multifamily housing development in Toronto, showcasing how smaller, community-focused residences can offer viable solutions to the city's affordability challenges. As Toronto continues to grapple with housing supply issues, projects like the St. George pave the way for innovative approaches that prioritize accessibility, sustainability, and livability. Our last topic today is a significant transaction in the commercial real estate sector. PRO, Real Estate Investment Trust, commonly known as PRO REIT, has successfully completed the sale of 12 retail properties located in New Brunswick and Nova Scotia for a total of $51.3 million. This sale marks a pivotal step for PRO REIT as it transitions towards becoming a focused light industrial investor, a strategy that began in 2023. The properties sold encompass approximately 277,000 square feet of gross leasable area, achieving a sale price of $185 per square foot, excluding closing costs. This transaction includes 9 properties that were previously announced as sold for $39.8 million, alongside 3 additional properties that closed for $11.5 million. Among the notable assets involved in the sale is the 2,480 to 2,485 King George Highway Shopping Center in Miramichi, New Brunswick. Originally disclosed as part of a 6-property retail portfolio, PRO REIT has now reported these as 4 separate buildings for this announcement. The buyers of these properties have not been disclosed. With this transaction, Pure REIT has achieved its medium-term target of having industrial base rent comprise 90% of its annualized portfolio base rent, marking a significant milestone in its strategic shift. This evolution from a diversified real estate investment trust to a pure-play light industrial REIT is a testament to the company's commitment to refining its focus and optimizing its portfolio. The proceeds from the sale are being strategically utilized. Approximately $27 million have been used to repay related mortgages, while $13 million are allocated to partially repay amounts drawn under PRO REIT's revolving credit facility. The remaining funds are earmarked for general business purposes. This strategic realignment is part of PRO REIT's broader plan to strengthen its position as a leading light industrial REIT in Canada. With the sale of these properties, PRO REIT now owns 106 investment properties, representing approximately 6.4 million square feet of gross leasable area. Industrial assets now comprise 92% of gross leasable area and 90% of annualized base rent. According to Gordon G. Lawler, the President and Chief Executive Officer of PRO REIT, looking ahead, we will remain focused on strengthening our position as a prominent Canadian light industrial REIT and on delivering long-term, sustainable value for our stakeholders. This commitment underscores the company's forward-looking approach and dedication to creating value in the industrial sector. That's it for today's episode. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy McKay. See you on the next one.